Well, you know what I think about these numbers. I think they're all bogus because they're just made up, right? I mean, they're all the birth-death ratio. They've all got these seasonal adjustments. I said, what's really important to me is what they revised last month and the previous 2 months, because no one looks at the revisions. They only talk about the number. And so I think if you go back and you look like over the last year, it was like a third of the reported jobs vanished in the revisions. So they weren't really there. I mean, it's like a tree falling in the forest. If there's no one there to hear it, it didn't happen. If the job really didn't exist, just because you said it did, it's like when you put a big number on the first estimate of GDP and then you revise it down, like, well, it was never the high number. It's the actual number. Or if you go the other way, right? If you do, small, then you build up.
On Wednesday, the Federal Reserve once again opted to maintain benchmark interest rates, a decision made against the backdrop of a growing economy, a dynamic labor market, and inflation levels that remain well above the central bank's target. As anticipated, the Fed's rate-setting group unanimously agreed to keep the key federal funds rate within a target range of 5.25% to 5.5%, where it has remained since July. This marks the second consecutive meeting that the Federal Open Market Committee has chosen to maintain rates, following a series of 11 rate hikes, including 4 in 2023. The decision was accompanied by an upgrade to the committee's overall assessment of the economy, prompting a rally in stocks, with the Dow Jones Industrial Average gaining 212 points in the session. Federal Reserve Chair Jerome Powell, in remarks during a news conference, acknowledged that the process of achieving sustainable inflation down to 2% still has a considerable distance to cover. Powell emphasized that no decisions have been made for the December meeting, emphasizing the committee's commitment to doing what it deems appropriate at the time. In an upcoming video, we will delve into a detailed discussion with Mark Yusko about the Federal Reserve, job numbers, and the broader labor market. Yusko also shares insights on banks and technological evolution, expressing a perspective that Bitcoin may be currently overhyped. Let's now proceed to explore the insights in the video.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
The thing that I think is interesting is we created QE. When I say we, meaning they, so they, the Fed. And, again, we all know, well, maybe we don't all know, but the Fed was created to support the banks, right? It's a private corporation that supports its members, which happen to be the banks. And that's what central banks do. And they're the lender of last resort to those banks to make sure that they can maximize their profits. And when they cut interest rates to zero and started buying bonds, what were they doing? They were essentially bailing out the banking mistakes of the global financial crisis, right? The banks vaporized their balance sheets, right? Totally destroyed their balance sheets by over-levering. And again, leverage is just a tool. It's not inherently evil. But as the great Howard Marks says so eloquently, leverage can never make a bad investment good. Can't. Right? It can, and often does, unfortunately, make a good investment bad because you're forced to sell at the wrong time and your equity disappears. So like if you buy a house for cash and the price goes up 10%, you make 10%. That price goes down 10%, you lose 10%. But no one can take it from you because there's no liability. It's yours. If you buy for 20% down, 80% mortgage, 4-to-1 leverage, and the price goes up 10%, you don't make 10%. You make 50%. I love leverage. So let's do 10-to-1. Let's put 10% down. Price goes up 10%. I made 100% on my equity. The price goes down 10%. All your equity vanishes. All of it. So all of the bank equity vanished. I mean, I think I've told the story on the show. I was with Chase Coleman in 2009, early 2009, right when QE started. And he crushed it. In 2007, 2008, he short all the banks, short the financial companies, tonned it. I mean, the markets were down 52% peak to trough. They were up well over that. But in 2009, market took off after Obama said, hey, buy stocks. We got your back on March 9th, 2009. And by this time, November of 2009, Chase was down like 10% and the market was up like 20%. And I walked in his office and he literally throws this thing at me. He said, look at this. Like, what is it, Chase? I mean, okay. He says, that's Citigroup's balance sheet. They are bankrupt. Their liabilities exceed their assets. There's no way this stock should have any value. I've been short. I shorted it from $100 down to $1. Now it's $5. And he said, and then it hit me. It's inconvenient for too many people for Citigroup to go to zero. Mm. And he said, I'm not shorting banks anymore. And that epiphany, right, that they weren't going to let those banks go, right? There was no chance Goldman Sachs was going away. Now, Lehman, he could let that go because they didn't like the guy who ran it at all. Like, they really just didn't like him. Bear Stearns, they didn't like the way they were scalping arbitraging certain markets. And the big guys were like, yeah, we could get rid of them. And then we would make all the money. So let them go.
The decision on Wednesday to maintain current interest rates is influenced by a slowdown in inflation compared to the rapid pace observed in 2022. Surprisingly, the labor market has demonstrated resilience despite multiple interest rate hikes. These increases are strategically targeted at moderating economic growth and rectifying the supply and demand imbalance in the labor market. According to department data released earlier on Wednesday, there were 1.5 available jobs for every available worker in September. Core inflation, as indicated by the latest reading of the Personal Consumption Expenditures Price Index, stands at 3.7% annually. While this figure has steadily decreased throughout the year, it remains well above the Federal Reserve's 2% annual target. In an upcoming segment, we will hear Mark Yusko's insights on technology, blockchain, and Bitcoin. Stay tuned for his perspectives on these topics.
Look, the thing about this technology is it's unique, right? We've never had this before. We've never had a technology that you can own directly, right? You can't own electricity. You can't own TCP/IP. You can't own, all kinds of technological innovation over the years. And you can own companies that do things with it. You can own apps that sit on top and use TCP/IP. But now you can actually own the blockchains themselves. And that's pretty interesting. Now you could say, well, they're like companies, but without humans and without boards and without, so fine, you could say that. I mean, as opposed to just a pure technology, but really it's a technology. And look, I am struggling a lot with, I'll make the maxis happy for a second, with this idea that Bitcoin could become the global settlement layer for all assets in the world. It's actually, I'm coming around to the idea that it's actually possible. That not just it's a better form of money. It is, right? Digital gold. It is a better form of money. But it actually, my on-chain monkeys guys have settled multiple projects onto the Bitcoin blockchain, like valuable assets, whether it's the original, Genesis monkeys, or whether it's this Dimensions 3-dimensional mint they did, or whether it's the Bugatti eggs, right? These are $200,000 collectibles that, are settling straight to Bitcoin. And if you think about this whole decision, if you have an asset, whatever that asset is, title to a house or a stock certificate or, money, you probably feel pretty, you want to hold on to it, right? You want it someplace safe. And what did that mean in the old days? Bank vaults, like big buildings with columns and thick walls and multiple locks. And you put it in there and you had a key to your safe deposit box and it was safe. Until the bad guys came in and cracked the safe and stole all the stuff. So then we figure out this DTCC thing and this digital thing or this electronic thing. And so we have electronic, but stuff still gets stolen. Well, now we have digital, which is an enhancement over electronic, which is an enhancement over analog. And there's these different mechanisms for asserting proof of work, proof of stake, proof of history, proof of whatever. Proof of work is superior from a safety and security perspective, at least for me, right? Just based on the power of the network and the amount of compute. And that's the other thing is, the longer you're around this, the more you realize it isn't about speculating on tokens. I mean, that's fine and it's fun maybe, but it's about understanding the technology, the base technology, and how it's being integrated in this giant S curve. Right, we're 10% in to adoption, which means got somewhere between 10 and 20% adoption, depending on what project you're looking at. We got the whole upside of the S curve to go, and it's that technological evolution and adoption cycle that's really unbelievable. That's why I'm out here in California at 5 a.m, talking on the tube.
On Sunday, top oil exporters Saudi Arabia and Russia jointly affirmed their commitment to maintaining additional voluntary oil output cuts until the end of the year. This decision stems from ongoing concerns about demand and economic growth, which continue to exert pressure on crude markets. Both countries indicated that these cuts would undergo review next month to assess the possibility of extension, deepening, or augmentation. Saudi Arabia specifically confirmed its intention to persist with an additional voluntary cut of 1 million barrels per day, equating to a production of approximately 9 million barrels per day for December. According to a statement from the Ministry of Energy, this supplementary voluntary cut by Saudi Arabia is aimed at reinforcing the precautionary measures implemented by OPEC Plus countries to uphold the stability and balance of oil markets. Following the Saudi announcement, Moscow also declared its commitment to maintaining an additional voluntary supply cut of 300,000 barrels per day from its crude oil and petroleum product exports until the end of December. OPEC Plus, consisting of OPEC countries and key allies like Russia, has been implementing output cuts since the previous year as a preemptive measure to sustain market stability. Despite geopolitical tensions in the Middle East providing some support, oil prices reached a 2023 high in September, at nearly $98 a barrel for Brent crude, but have since retreated to around $85 a barrel as of Friday. Saudi Arabia, the de facto leader of OPEC, initially introduced the voluntary cut in July, extending it through the end of the year with a review scheduled. Analysts widely anticipated this confirmation of the extension in December. The ongoing decision by OPEC Plus already places constraints on supply into 2024. The alliance is scheduled to reconvene on November 26 in Vienna. Share your thoughts on whether oil output cuts will persist or if an end is on the horizon in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.